Hi guys, welcome to another video of Hidden Crypto Gems. In this video, I am going to talk about the stagflation period of the 80s and the high inflation of the 70s. Because in this period, it showed how Fed was dealing with high inflation. By understanding the Fed's action back then and the effect that it had, we can use it to make an educated guess of when the markets are going to the bottom. The video will cover how the stagflation started, how the stock markets were during the stagflation period, and what can we expect from the Fed in the coming months. For those who are new to Hidden Crypto Gems channel, I only talk about cryptos on this channel. The main topics are new projects in decentralized finance, NFT, play-to-earn games, and other crypto-related subjects. If you like what I talk about, then give this video a thumbs up and subscribe to my channel. Make sure that you follow my Twitter FBAN84 as well and join my Discord group. Links are in the description. This way, you won't miss any life-changing opportunities. For disclosure, I am not a professional financial advisor. I only share my thoughts and views on my investments. Before you make any investment, you need to do your own research and due diligence. Now let's get on with the video. The global economy is once again grappling with acute shortages of critical commodities, largely though not entirely a result of Russia's invasion of Ukraine. And again, policymakers must face the challenge of steep rises in prices across the economy. This is leading to growing concern that we may be heading for a replay of the 1970s when inflation and unemployment both soared and real economic growth stagnated. For most of U.S. history, inflation had rarely been a big problem. Sure, the nation had bouts of high inflation, but it was usually around wartime, and the episodes were short-lived. America had never seen a decade-long stretch of high inflation. That changed during the Great Inflation. Stretching from the mid-1960s to the early 1980s, it's a period known for itty-bitty shorts and two socks, roller disco parties, cocaine, long lines at gas stations. The 1973 oil crisis began in October 1973 when the members of the Organization of Arab Petroleum Exporting Countries, known as OPEC, led by Saudi Arabia, proclaimed an oil embargo. The embargo was targeted at nations that had supported Israel during the Yom Kippur War. The initial nations targeted were Canada, Japan, the Netherlands, the United Kingdom, the United States, Portugal, Rhodesia, and South Africa. By the end of the embargo in March 1974, the price of oil had risen nearly 400%, from $3 per barrel to nearly $12 per barrel globally. U.S. prices were significantly higher. The embargo caused an oil crisis or shock, with many short and long-term effects on global politics and the global economy. It was later called the first oil shock, followed by the 1979 oil crisis, termed the second oil shock. And today we might face a third energy crisis. Between 1965 and 1981, annual inflation averaged more than 7%. In 1979 and 1980, average inflation peaked at almost 13% a year. In the same period, the stock market declined as well. However, till September 1979, the Fed did not raise interest rate. By doing nothing, the stock market was basically in a bear market for 15 years. The story of the Great Inflation begins with deficit spending. John F. Kennedy had run for president during a recession and promised to get America moving again. As president, Kennedy proposed a big tax cut to boost the economy and lower unemployment, which stood at almost 7% when he entered office. It was the same strategy that Donald Trump used during his presidency. After Kennedy was assassinated, Lyndon B. Johnson, his successor, followed through with the tax cut, which helped bring unemployment down to 4% by the end of 1965. That was the level of unemployment that macroeconomists at the time believed was full employment, or the theoretical threshold when the labor market starts to get so tight that wages and prices start to explode. From a macroeconomic policy perspective, it would have been a logical moment to ease up on the accelerator, but foreign policy and social goals took priority over economic stability. When President Johnson plunged America even more deeply into the war in Vietnam in 1965, he opened up the firehouse of federal spending. Defense spending rose about 4% to 4% between 1965 and 1968. America would spend almost $850 billion on the war in today's dollars. Because the war was already unpopular, Johnson was reluctant to support tax increases to pay for it, meaning this was a bunch of new money juicing the economy. So, basically, the Federal Reserve was funding the war. At the same time, Johnson launched his war on poverty, what President Biden failed to do, and the Great Society programs. This included creating the government healthcare programs Medicare for elderly Americans and Medicaid for low-income Americans, which both began in 1965. Many Great Society programs would ultimately have important benefits, but they also had the effect of adding further to government spending. All this deficit spending heated up an economy that was already running hot. Military contractors used government money to build guns, bombs, planes, and helicopters. Medical providers used government money on procedures, checkups, hospital expansions, and so on. This increased demand for labor and materials already in short supply, pushing up the price of everything. By the time President Nixon came into office in 1969, inflation was surging. Nixon continued the inflation fest with policies like an intensification of the Vietnam War, deficit spending, and as we shall see, sticking his nose where it didn't belong, monetary policy. Early in his presidency, Richard Nixon appointed a close ally to head the Federal Reserve, Arthur Burns. Often pictured smoking a pipe, Burns was an economist at Columbia University who served as the economic advisor to Nixon's 1968 presidential campaign. Once Burns was installed at the Fed, Nixon had no reservations about using their relationship to his political advantage, according to Ben Bernanke. With unemployment having risen during the 1970 recession, the president wanted a strong economy going into the 1972 election. Leaked recordings from the Nixon White House, the so-called Nixon tapes, provide smoking gun evidence that Nixon directly pressured Burns to stimulate the economy with looser monetary policy, even though a temporary boost in economic growth did not serve the long-term interest of the economy or the public. In 1973, when the supply shock of skyrocketing oil prices hit the economy, inflation got worse, and so did economic growth. Inflation became stagflation, or inflation combined with stagnating growth, something many economists at the time did not even believe was possible. Nixon's response was to try and cap the price of oil. Bernanke and most other economists blamed this policy for creating shortages and infamous lines at gas stations, while also failing to get inflation under control. For whatever reasons, Burns failed to use the powers of the Fed to end high inflation. Even after it was clear that price controls failed, and even after Nixon resigned, Burns continued to shy away from raising interest rates to the level needed to end inflation, fearing it would cause a deep recession. Instead, he let inflation fester throughout the 1970s, which convinced the public that inflation was here to stay. Companies and workers conducted their business and contract negotiations accordingly. These inflation expectations, as economists refer to the psychological component of inflation, made price increases even worse. Part 2. How did the markets react and behave during the stagflation period? The commodity connection makes the parallels with the 1970s particularly striking. Then, as today, military conflict triggered a surge in oil prices that added fresh momentum to inflationary pressures that had been building for several years. In 1973, Egypt and Syria launched a surprise attack on Israel, the Yom Kippur War. In response to U.S. support for Israel, Saudi Arabia and other oil exporters unleashed the oil weapon. This included a ban on oil exports to the U.S. and a series of production cuts intended to increase competition for oil and fragment the unity of Western nations. Oil prices almost tripled. As the world started to recover from this shock, the Iranian Revolution and Iraq-Iran War of 1979–1980 led to another surge in energy prices. Stock markets around the world were volatile in the 1970s. The S&P 500 fell almost 40% during a bear market that lasted for most of 1973 and 1974 before rebounding over the next 5 years. The UK fared even worse, with the FTSE All-Share losing more than 70%. Inflation is normally a longer-term worry for investors, but it reached such high levels in the 1970s that returns were eroded in a relatively short time frame. On an inflation-adjusted basis and including dividends, large-cap U.S. stocks lost 1.4% per year during the decade, according to data from business school NYU Stern. This is a far cry from the returns investors have enjoyed more recently. Over the past decade, the comparable return has been 14.0%. Over the past 20 years, it has been 7.0%. Profits actually grew in nominal terms by 9% annually during the 1970s. However, fearing that the economic malaise would never end, the multiple that investors were willing to pay for those earnings roughly halved, with the S&P 500 ending the decade on a P/E ratio of just 7.5. T-bills and government bonds also delivered negative real returns over the decade, minus 1.0% and minus 1.8% respectively, but in an age of deep pessimism, they may have been the preferred option for many investors. Traditional investments therefore performed poorly in the 1970s. Investors who diversified into real assets achieved much better returns. The star performer of the period was gold, which increased in value almost sevenfold, and that's after adjusting for inflation. Other commodities, such as oil and wheat, also performed strongly. Over the course of that decade, oil prices went from about $2 to $32. It's difficult to see that 16-fold gain in oil prices might happen again, given the unique shocks that drove it then from the end of Bretton Woods to the Iranian Revolution. In the case of the former, currencies that have been unpegged from a gold standard cannot then be unpegged again. And in the case of the latter, new oil supply shock absorbers have been introduced since then, namely OPEC and the rise of the U.S. shale industry. In fact, through a 1970s lens, oil has been stable for decades. Meanwhile, the consumer's wallet has continued growing alongside, such that consumption is a lot less energy intensive today than it was then. Indeed, gasoline is only about 2% of the U.S. consumer's wallet today, down from about 6% in 1980. Thus, higher energy prices this winter can lift energy asset prices. How did the stagflation ended? Former Fed Chairman Paul Volcker is a well-known Fed chair who finally killed off the nasty inflation of the 1970s when he first took over the position in August 1979 till 1987. Volcker may have taken over the job as central bank chief during one of the worst market environments the Federal Reserve has ever had to grapple with. In many ways, the U.S. economy was still recovering from the brutal recession and bear market of 1973-1974. On October 6, 1979, Fed Chairman Paul Volcker took dramatic steps to rein in the runaway inflation that had been sapping the strength of the U.S. economy since the mid-1960s. Volcker was the man who, in an inflation-obsessed era, the 1980s, worked out that reacting to a rise in inflation didn't work, and that central banks had to get ahead of the inflation curve and start setting policy, raising interest rates before inflation became an issue, not after. To effect that theory, Volcker preemptively raised the federal funds rate, which had averaged 11.2% in 1979 to a peak of 21% in June 1981. The markets were gobsmacked. Recession set in 1980-1982 and inflation collapsed. U.S. inflation, which peaked at 14.8% in March 1980, fell below 3% to 2.5% by 1983. Without his bold change in monetary policy and his determination to stick with it through several painful years, the U.S. economy would have continued its downward spiral. By reversing the misguided policies of his predecessors, Volcker set the table for the long economic expansions of the 1980s and 1990s. Volcker, in office only 2 months, took the radical step of switching Fed policy from targeting interest rates to targeting the money supply. The days of easy credit turned into the days of very expensive credit. The prime lending rate exceeded 21%. Unemployment reached double digits in some months. The dollar depreciated significantly in world foreign exchange markets. Volcker's tough medicine led to not one but 2 recessions before prices finally stabilized. Paul Volcker's greatest legacy as Fed chief was breaking inflation with shockingly high interest rates, but he turned the housing market into a nightmare for both buyers and sellers. Volcker allowed the Fed funds rate, now topped out at 1.75%, to rise over 20%, and with it went the interest on home mortgages and everything else. The 30-year mortgage rate spiked into the high teens in late 1981 and continued at double digits until 1990. People thought they'd never buy a home again, and they did, said Diane Swank, chief economist at Grant Thornton. What was amazing was the back-to-back recessions of 1981 and 1982, which he used to break the back of inflation. He tightened policy and brought the economy to its knees. He flipped the switch again, and the economy powered forward in a way it hasn't since. Ruppy said that when rates were streaking higher, many home buyers couldn't get credit from banks. They didn't think the home buyer could afford the interest rate, so they would limit the mortgage home buyers could get, he said. So what happened, especially in some of the higher-priced markets, is the home seller would own the loan to get the home sold. How were the markets when the stagflation ended? The market peaked on November 28, 1980, just 24 days after the 1980 presidential election in which challenger Ronald Reagan defeated incumbent Jimmy Carter. Inflation was at 13.58%. On February 22, 1982, the S&P 500 price index dropped to 111.59, down minus 20.59% from its prior high on November 28, 1980. The market had been dropping for 451 days, 1.2 years. In 1979, President Jimmy Carter had appointed Paul Volcker as chairman of the Federal Reserve. With inflation running double digits, the Federal Reserve under Volcker raised the federal funds rate from 11.2% to 20% by June of 1981. The intent was to break the inflationary spiral within the United States. But raising the federal funds rate also made it more difficult to borrow money. This helped cause the 1980 and 1982 recession and a national unemployment rate of over 10%. As a result, the bear market of 1982 could be called Volcker's bear. For those who did not live through those days, they were some of the difficult days of the Cold War. Carter had rejected the policy of détente and pressed the Soviet Union regarding their internal human rights violations. In January of 1980, Carter curtailed trade with the Soviet Union and placed an embargo on sending them grain. At the moment, we are facing the same grain crisis as Ukraine and Russia can't export because of Putin's invasion. 18 days later, the Soviet Union arrested civil rights activist Andrei Sakharov. In June, Carter required all young men from 18 to 25 years old to register for a military draft. That summer, Carter organized a boycott by 6 countries of the Summer Olympics in response to the Soviet invasion of Afghanistan. A series of strikes in Poland ended with the Gdansk Agreement recognizing Solidarity, the first independent trade organization. The following year, Pope John Paul II received Lech Walesa at the Vatican. 4 months later, the Pope is shot 4 times by a gunman assumed to be on orders from the Soviet KGB. Polish demonstrators protest food rationing in the streets of Lodz. Later that year, Polish First Secretary Wojciech Jaruzelski declared martial law. Other quieter headlines of those years include the beginning of new services and technologies such as the Global Positioning System, GPS Pac-Man, and Donkey Kong. Inquire the beginning of the work which resulted in the World Wide Web 10 years later, the DIX standard for Ethernet, compact discs, CDs, and the introduction of the IBM personal computer. It seems like history is repeating itself. Despite the Russian invasion, political tensions with China and Russia. Good technologies are being developed, metaverse are being built, decentralized finance, space travel. Invest wisely now and you could make a fortune. These milestones would impact the stock market far more than the political worries. The S&P 500 bottomed 171 days later on August 12, 1982 at 102.42, down minus 27.11%. By the time the stock market had bottomed, inflation had been reduced by 8.39% and was only 5.04%. Around this time, investors had the confidence and faith that the Fed can control the inflation. And with the Nixon's tax cut plan, the future was looking bright again. After bottoming, the market fully recovered its prior peak just 83 days later on November 3, 1982. That day, the Dow Jones Industrial Average surged 4.25% settings, its first all-time high in more than 9 years since January 11, 1973. The entire cycle lasted 705 days, 1.9 years, 622 days from prior peak to the bottom and 83 days back to the prior peak. Bear markets are often a precipitous decline followed by a slower and steadier recovery. Volcker's bear is rare in that a slow and steady decline was followed by a sharp precipitous recovery. After recovery, the market continued its upward trend for an additional 11 months. The total 14-month bull market ultimately peaked on October 10, 1983 at 172.65, up 68.57% from the bottom of the bear market. By the time the stock market peaked, inflation had been reduced to just 2.85%. During the total recovery from the bottom, the markets experienced an annualized return of 56.80%. The quick recovery after Volcker's bear shows that economic hardships do not require government stimulus or low interest rates to aid recovery. In fact, the government's solution, which worked such wonders during this time period, involved raising interest rates, lowering taxes, and removing regulation. This bear market also shows that even when the economy is in the midst of double-digit inflation and double-digit unemployment, it is still better to be invested than not. This was a market where it was better to get into the market a year too early than a month too late. I hope that you have enjoyed the video and gained some value from it. Let me know in the comments. Make sure that you subscribe to my channel for more great content. For now, have a nice day and see you in my next video.